What's going on today, YouTube? Today, I want to tell you guys about the two different kinds of investors. Now, there's a speculative investor and a value investor. I'm going to tell you guys the difference. Make this real quick. A speculative investor, he is someone that looks at my dog's getting in the way. Technical chart patterns. He's looking at technical chart patterns, and it's all speculative trading. You either trade on something going up, you trade on what else? Something going up, you trade off of news, you trade off of estimates, like their quarterly, their revenues. That's what you're trading off, speculative. Now, a value investor, this is something like Warren Buffett does. He'll invest on products, say, he'll look at a company's fundamentals and then he'll invest on them. And I'm not saying either way is a right way or a wrong way, but a lot of people, they like to know the difference when they put apart their money. Everyone has a speculative fund, which is honestly, it's more of like a gambling sense. You're kind of betting based off certain things, whether that stock's going to go up or down. And then a value investor, they look at the fundamentals of that company. So they're going to say, okay, I like the leader, I like the CEO, or I like what this company's doing. I like their products. They have a good revenue coming in, like all sorts of stuff like that. And another thing is, you should always, because everyone has that speculative nature in them. Everyone has a gambling nature in them. You should always have a speculative fund and a value fund. Now, for me, my value fund, I invest in index funds. For me, that gives me a broad, I own little bits of every stock rather than just going all in on one stock. I own bits and pieces of all good companies, and they're always good companies when you're based on your index fund. You could have index funds that are just all in gas, all in utilities, like different categories, or you can have broad ones. I recommend. I just to look into. Look into Vanguard Total Index Fund, VTI. Now, I'll make a video on this, but I started investing in that back in March, and it's made 15% since I've been in it, which is huge. That's not even a whole entire year, and I'm already 15% higher. And they have the reason that I like them and chose them is because they have a lot of pool. A lot of the stocks are in technology, and technology, as you guys know, has been booming. So, that's why I liked it. That's why I chose it. And who knows, there could be something else that booms in the future, but that's why I chose that one I did. Now, more on a speculative investor. Speculative investor, so they'll trade based on signals. They like to trade when stocks are going up. This is a common mistake that I want to get you guys off of now. One thing a speculative investor does, he'll buy when things are going up, and he'll sell when they're going down. And this is what the majority of the world does, and this is why the majority of the world loses money. This is one of Warren Buffett's even greatest things that he ever came up with. He always says, when everyone's swimming in the ocean, I think this quote's something like, when everyone's swimming in the ocean, you don't want to be left in the ocean left naked. And what he's trying to say by this is, when everyone else is into something, it's probably time to get out. And the whole reason this is like this in the stock market is because, think about it, when everyone is into a stock, that's going to drive their price higher and higher and higher to get less people into that stock. Now, when so many people are in it, they're investing off of the price action rather than the actual value of the company. The price gets way overinflated for the value of that company, which means this has nowhere to go but go down. Think about it. Come on. If everyone's into something, you're just it gets way too overpriced, and the actual company's fundamentals don't cover their price. And that's why it falls faster than it rises, because when it starts falling, people are panicking when they see the stock falling, or earnings come out and they're like, hey, this company is not worth anything near where the price is. So people are just dropping it left and right like crazy. And it takes longer for people to get into something than it does to get out. So, an example, think of even Bitcoin. There's people like the price, it goes up and up and up and up and up, and then people are like, oh my god, like this is never going to stop. I'm just missing out on all of this. And then what happens, guys? It falls. Bitcoin went from 20,000 down to 9,000. And that's why it got way too there's way too many people in it. It's not valuable enough for the price it's representing. So those are the main differences between value investor and speculative investor. Don't get me wrong. People benefit all the time from speculative investing. But the applications to do it, they take a lot of time and a lot of dedication, and they're possible, but they're not easy to master. That's why, statistically, 95% of the people that trade stocks on a daily basis lose. Because they're strict patterns, and like honestly guys, the people that are successful in the stock market, day traders, swing traders, they follow specific rules and they get out before they have massive losses. They don't hold and hope. They don't hold and say, oh, I know the stock's going to go up while it's going down and down and down and down. And then by the end of it, the stock either goes bankrupt or they've lost so much it really doesn't matter by this point. But that's why. Now, if you're going to be a day trader, swing trader, you need to be disciplined, make your losses smaller than your wins. And as simple as this can be, if you see a stock, like a lot of what I like to do, I see stocks that have potential to gain like 10%, say. Now, it has potential to gain this, but I'm not going to let myself lose more than 2% when I go in. So, to me, that's a 5-to-1 ratio of my risk/reward. So, I need to get 4 out of 5 trades wrong to lose money. If I get one trade right out of 5, I'm pretty much break even as long as I follow my 2%, 10% rule. Now, yes, you could put stop losses up for 2%, but there are times where you lose a little more. But you also, if you're right on your trade, you could gain a lot more. So if you minimize those losses, you make out in the long run. Now, another thing I want to talk about, because everyone knows about Warren Buffett. And this is actually out of the book The Intelligent Investor, which is written by Benjamin Graham, which is who basically Warren Buffett looked up to. He had 3 principles. He was a value investor, so is Warren Buffett. This is what they do. They fully analyze a company before they buy it. And they don't even look at the price of that stock. They just say, I like this company, its price is like they're going to rise in the future. They don't look at the current price or anything. So they're solely basing their investment off the company's fundamentals. And they protect from serious losses. They're diversified. They don't put everything in one basket, which is kind of what an index fund is. I'm not all in on one stock. Their index fund covers multiple stocks. And they aspire to get adequate performance, not extraordinary. And honestly, that's going back to the same thing with risk management. You want to have a possibility for a 10% gain, and you want to cut your losses at about 2%. And this number can be different for everyone, but I like that ratio. Follow these 3 rules. Make a Benjamin Graham likes to call it a mad money account. Making a mad money account, which is, he likes to say 10% of what you are willing to invest. Like 10%, and remember guys, this is always money that you can afford to lose. It's not money that you need to pay your bills with. It is extra money that you can afford to lose. Make 3 rules with this. Never think you're investing when you're speculating. So if I'm investing, I'm leaving my money in there long term. If I'm speculating, I'm playing with the market. And again, make your speculation account different than your investment account. Keep your investments different. Have different prices, have different values. They can go up or down over time, but don't mix them together. You don't want to have speculative money, have a bad trade, lose it all, and then take all of your actual investment money and switch it over to your speculative account. If you're losing once, you got to figure out what you're doing wrong or you're just going to keep on losing and losing, and you'll be left with nothing. Now, speculative investing is very dangerous when it's not taken seriously, or it is taken seriously. You can look at it either way. You don't take it seriously, you don't look into it. You're just like, oh, I'm gonna invest in this stock because it's going up, and that you can't do that. You need to have your reasons and your price in, price out, and hey, always have strict limits on what you're willing to wager. Now, I hope this helped you guys. I hope you're starting off 2018 great. Comment on the video if you have any questions. Send me a message. Like it. Support the channel. Subscribe. I'm waiting for that first subscriber, guys. Come on. And, hey, let's keep going.